this is a slightly different investment trust. It's a fund of investment trusts, and so there's not many of those about, and it's quite different. It aims to be a long-term savings vehicle for private individuals, and that genuinely it is what this is about. It's not a short-term try to look for a quick gain or anything like that. Genuinely think of it as a long-term savings vehicle. We use the capital structure of investment companies. We've got two separate portfolios within the one trust. There's a capital growth and an income, really a total return fund. Gives you some capital growth and also a decent level of income. But it's got some actually unique features. I don't think any other trusts still on the London market have them. And I'm going to touch on that in a minute. I'll then go into how we've performed the investment trust generally, what's the outlook, and also our top holdings, what I've been buying and selling, which might be of interest for you. So this is the most difficult part, really, because in one of the bullet points there was income transfer, and you think to yourself, oh my goodness, what is that? Well, this investment company, think of it as an umbrella. We've got two quite separate portfolios, a growth and an income. And let's imagine at the beginning of the year, they're both valued at 100, and see the two boxes there. And the income pool has got a yield of about 4. And that's what it was when we launched this in 2008, to be honest with you, pretty much what its yield is now. And similar for the growth pool, it's got a yield of about 1. So if you focus on that box that says growth pooling, and we're going to imagine that everything stays the same over a course of the year, it receives dividends of about 1, or the portfolio is yielding 1%. And so when that happens over the course of the year, if you go and look at the -1, those dividends get put on a conveyor belt that goes across to the income pool, which boosts its income, and at the same time, exactly the same amount goes back from the income pool to the growth pool. And so at the end of the year, remember everything has stayed the same for the year, the NAV, the net asset value of the income pool, is 99, but it yields 5. And similarly for the growth pool, which does not pay a dividend, shareholders don't want a dividend, so there's no dividends paid out, but the NAV has gone up to 101. And the box on the right is what HMRC sees. There's no adverse tax implications at all in this, one way or the other. So it's a small, interesting little feature, and over the years I can tell you it's hugely benefited the income pool. I've never had to really chase high-yielding investments, which can sometimes be quite risky. And similarly, it gives a little boost to the NAV, the net asset value of the growth pool. So that's the income transfer. That is unique. Doesn't exist anywhere else. Conversion facility. So remember, you've got two separate pools, you've got separate share prices, separate portfolios, and once a year, after where our EGM is at the end of September, investors can switch between the growth and the income pools at net asset value. Now there are maximum and minimum levels. The minimum level, which is about £250,000 for this to actually take place, have been exceeded now for quite a number of years. And actually costs get to a minimum. Costs for the investor are 0 because they're borne by the managed portfolio trust. So it's been proving increasingly popular, with a lot of people now actually take the opportunity to switch from one to another. You can see here under current law, it's not treated as a disposal for capital gains purposes because you're within the one investment company. And the big thing is, what's happening is the growth shares, capital growth is the objective. The shareholder register tends to be, how can I put it, younger than the income pool. So over time, people might go into the growth pool, the growth share class, and then find that they need some more income and they can switch from growth to income. Similarly, actually quite often it could be the reverse as well. But that's an interesting facility. As I say, it actually doesn't cost anything to the shareholders, and it's done at asset value. Now, the third point I had in the previous slide was about discounts. And the discount of the managed portfolio trust, and here's a chart for you. This, I think, is the income portfolio we launched, as Matthew said, 15 years ago tomorrow. And that zero line means that you're trading at par, at asset value. And so you can see actually for the last, 8 or 9 years, give or take, we'd be trading at very small premium. So what I didn't want was for a discount on the underlying portfolio and then a second discount on the managed portfolio trust. So the income shares trade on any given day. It might be a discount of 1, a premium of 2, spot on asset value. It's round about asset value. And the same for the growth shares. You can see early on, it was quite a lot of volatility. Well, remember we launched in 2008, so then the financial crash that autumn made brilliant time to launch an investment trust. But we did get that sorted out, and so you should have confidence that this trades round about par, and it does. And so here's just a very brief summary for you of what we're about. We launched April 08. I think the big thing from this is the share register. There's no institutions, there's no private wealth managers, no Raspos, no Bruin Dolphin, none of that. It's just 16,000 individuals, and you can work out roughly about £10,000 each. So it's really small shareholders. A lot in the growth portfolio. We have junior ISAs, grandparents saving for grandchildren, that type of thing. And the income portfolio, obviously, let's just say more experienced investors who quite like a dividend yield. But we've issued about £50 million worth of shares over the last 7 or 8 years. So the steady issuance happens. Occasionally I do buyback shares as well in order to keep the share price round about asset value. So that gives you a flavour for what we're... I'm not really going to go into this a lot, why consider investment companies, but I do actually just want to mention this one because most of the time, most of the last decade, the last 20 years, mid and small cap companies slightly outperform big companies. When it stands to reason, it's a wee bit easier for smaller companies to grow a bit quicker. There are times when they don't. When mid and small caps outperform, most active fund managers will do better than the index because that's what they look for to try and get superior performance. But right now, the past year, 18 months, it's been the FTSE 100 that's led the way. And so you've tended to find, in fact, almost all fund managers up to a greater or lesser extent had difficulties in performance over the past year. So this is explained also with this chart, and I mean, it's what's called a relative chart of the investment company subsector of the all-share index, about 6.5% of the all-share index, divided by the all-share. And simply put, when the line is rising, investment companies are outperforming. When it falls, they're underperforming. And so you can see, I've done this for 10 years, but honestly, you could do it for 20 years. Investment companies were gently outperforming for most of the decade. You then had 2019, and things really started taking off, and some extremely strong performance through to the autumn of 2021. And then, whoops, we gave back almost all of the gains that they've made the last couple of years. So they've been underperforming recently. And one of the reasons for that, well, a couple of reasons. The first one I'd mention, when we started getting inflation, interest rates going up, bigger companies, supposedly stronger companies, BP, Shell, Barclays Bank, miners, utilities, tobacco companies did really well. They have all performed well in the past 18 months. In the long term, I'm not sure if BP, Shell or British American Tobacco will be great growth investments, but they've been tremendous for the uncertain times we've been in with war, inflation and rising interest rates. What I've got here is the other reason for investment companies underperforming. The sector discount. It's just an average of all the listed investment companies on the London market, and you can see it roughly about 4 or 5%. The beginning of the lockdown bounced back right away, and at the beginning of last year, the average sector discount was 2. I mean, to us, it just wasn't an issue. There's a lot of trust trading round about par, which was fine. But since then, wow. And at the end of March, the average sector discount touched almost 17%. But that is as wide as it's been this century. So, advise that. It's difficult to put your finger on quite why, but enough to say just general uncertainty, very adverse investor sentiment. People have been quite negative about things, and understandably so. I mean, inflation in double digits, interest rates going up. But that's how we are now. So, just one quick page on the income portfolio in general terms, so you can see a horrible performance of the past year. The all share was up 3, and we were down 13 in the growth portfolio. So that just reflects what you've just seen with average sector discounts. They've ballooned their way out. Over the longer term, it begins to look a bit better, and that's over 10 years the growth portfolio has outperformed, and they're both just ahead of the index over 15 years. But that's massive underperformance you've had in the last 12 or 18 months, which really is not been seen for a long time. However, this is a busy slide, and so I just want you to concentrate. It's every financial year. We're at May year end of it since we launched in 2008. And if you just run your eye down the growth portfolio, and between 2013 and 2021, it beat the all shares 9 consecutive years. So that's kind of not bad going. And actually, in 2020, that should be, in 2021, by quite sizable margins. And then, whoops, the last full year, and then the 10 months to end March, it's given back a lot of that. And that's what I was saying. Big companies outperforming and discounts ballooning have been the cause of that. But actually, the same as the income portfolio, most years they've outperformed. And this is what I was thinking was coming up next. This is just one quick slide on the income portfolio and the dividend. So you see that's the yield of the all share as of last week, 3.6. Government bonds give you something similar. And then the income portfolio yields almost 6%. We've had 11 years of growing the dividend, and actually it's growing at something like 7 or 8% at the moment. So it's almost but not quite keeping up with inflation. And from a revenue perspective, it's going quite well just now. Can't make any forecasts, but it's going quite well. So I thought you'd like to see, just very briefly, the top 10 holdings. This is in the growth portfolio. That's as of the end of the month. Now, if you looked at that, at the beginning of 2022, that had been filled with technology trusts, buying tech, healthcare, which had done extremely well, and they were all at the top of the list. And I've sold a lot of them or reduced them in size. And where I have been buying, which will come on to the recent purchases, it's been in the UK. Law Debenture, Finsbury Special Values, Aurora, because I think the UK market is looking quite attractive just now. And there's also some defensive trusts in there, rougher, better than our macro. It's not that I bought shares, they just performed really well in a difficult environment over the past 18 months or so. And this is what I had me buy. This is just released this year, and you can see the common theme. Paying a visit to Aberforth in February, and they're a well-resourced small cap manager. And basically, the interesting thing is the portfolio they've got, the price-earnings ratio, which is a common yardstick to measure the valuation of the underlying portfolio, was 8 times. They'd never had it cheaper. Never ever. 8 times earnings. And Lowland, I saw them beginning of March, owned by James Henderson as a experienced manager. Portfolio's valuation is 9 times. I mean, that is really inexpensive. Of course, with it, when you look at valuations, they can stay inexpensive for a long time. But that really is quite attractively valued. And the same could be said for all of Henderson's smallers, and I have been buying some Finsbury Growth and Income, which is Nick Train's vehicle, which has been doing quite well of late. And I've sold out of, not surprisingly, Polar Cap Global Financials, which had too many banks for me, and property company, Urban Logistics, REIT. And there's the income portfolio for you. Again, some of these names might not, but look at the sectors, and you'll see Law Debenture and Lowland are the only 2 holdings in both the income and growth portfolios. Then you can see the dividend yields on offer. Merchant Trust be doing well, City of London, as well as some of the global equity income funds like JP Morgan Global Growth Income, we've just finished over the way there, and Mercantile, who were speaking earlier. And so these are what I've been buying recently, and actually I've been buying a lot of Mercantile. Lowland as well, the Invesco small cap. So you can see my attraction. UK mid and small caps have been out of favour really since the Brexit referendum in 2016. And what you're seeing now, with more merger and acquisition activity, that's the first signs of global investors coming back to the UK and recognising a lot of the companies are just very cheap. And so I've been reflecting that in the portfolio. And again, I've sold out of a couple of property companies which I was less attracted to. So really, just, I'm going to get this right in terms of timing. Very brief word on prospects. I don't think that is any news to you. I think inflation will peak very soon, and interest rates hopefully will start to move lower. They may go a little higher, but then I think they might move lower before the year end. We are seeing cuts in estimates for a lot of companies, and the magnitude of the slowdown that's happening is uncertain. In other words, are we just going to have a shallow of a dip, or will it be a quite severe deep recession? Now, we don't know that yet. But here's the rub. If you look at these valuations there, now the forward price-earnings ratio is the next 12 months price-earnings ratio for the Standard & Poor's composite. The consensus estimate's 18 times. The average over the last 20 years is 16 times. So the US market is a bit more expensive than historically it's been. Europe is about in line, and there's the UK. I mean, it's really quite inexpensive. So there you go. So what have I been doing? I've been increasing exposure to the UK mid and small cap investment companies where possible. But bearing in mind this is a long-term savings vehicle, I'd not sold out of a lot of the technology trusts and the like. It's just they're no longer big holdings. And where possible, I'm going to keep holding some of them. And so just a final one here, it might be interesting, because we listed in 2008. This is for the growth portfolio, and it's just to underscore that point. These are the trusts that really had delivered for us. Now, Scottish Mortgage is down in 50% from the peak. Allianz Technology, Polar Cap Technology are down probably about 40%.
and yet I still made 8 times my money in Alliance
Allianz Technology. Never bought a share since 2009.
And even with our Scottish mortgage, we used to have 8 times the money, but we still made 4 times. So man, the message here is these secular growth investment companies exposed to secular growth trends, that's where you will make
Multiple times your investment
over time.
and so I'm sticking with them. And I think at that,
I'm going to finish there. So thank you very much indeed.